where we analyze finance and accounting policies, the recent rollbacks in Consumer Financial Protection Bureau, what's happening now with the CFPB. Two major pieces of legislation reshape the financial sector.
Today's episode is sponsored by TaiPai. TaiPai revolutionizes enterprise application development, turning business ideas into robust, data, and AI-driven solutions. With TaiPai's drag-and-drop features providing intuitive user interfaces coupled with what-if scenario capabilities, TaiPai empowers business analysts to make insightful decisions that are fundamental to drive today's dynamic business.
Welcome back to Reporting Norms, where we analyze finance and accounting policies, their implications, and what they might mean for the future of our economy. I'm your host, Norm Osumi, and today we're diving into a topic that should concern every American, the recent rollbacks in Consumer Financial Protection Bureau, or CFPB, regulations, and how they eerily echo the deregulation of the late 1990s and early 2000s, which set the stage for the 2008 financial crisis. If history teaches us anything, it's that when financial regulations are rolled back under the promise of economic growth and innovation, the consequences often lead to economic disaster. What we're witnessing today with the weakening of the CFPB's authority under the new administration bears striking similarities to the financial deregulation that occurred in 1999 and 2000. These were deregulations that directly contributed to the housing market collapse and the financial crisis of 2008. In this episode, I'll explore the historical precedent of deregulation, what's happening now with the CFPB, and why these developments may be setting us up for another financial catastrophe in the near future. To understand the significance of today's changes, we have to look back at the late 1990s. Two major pieces of legislation reshaped the financial sector and laid the foundation for the reckless behavior that led to the 2008 crisis. Firstly, there was the Gramm-Leach-Bliley Act of 1999. This law repealed parts of the Glass-Steagall Act of 1933, which had separated commercial banking from investment banking since the Great Depression. The Gramm-Leach-Bliley Act of 1999 allowed banks to engage in high-risk activities, blending traditional banking with speculative investments. This gave rise to massive financial conglomerates that were considered too big to fail. So why was the Gramm-Leach-Bliley Act of 1999 passed in order to repeal the Glass-Steagall Act that was in place since 1933? So the late 1990s, as you recall, there was strong economic optimism fueled by a booming stock market and advancements in technology. Recall the internet boom. The belief was that financial institutions needed more flexibility to compete in a rapidly globalized economy. Proponents argue that loosening restrictions would increase efficiency, lower costs for consumers, and drive economic expansion. A bit of background on the Glass-Steagall Act and the Securities Act of 1933. So this act, the Glass-Steagall Act, was part of the key law passed by President Franklin D. Roosevelt under the New Deal. And it was designed to prevent conflicts of interest in the financial industry that followed the 1929 stock market crash. The law mandated a separation between commercial banking, which handled deposits and loans, and investment banking, which engaged in securities trading and underwriting. And additionally, at that time, in 1933, the FDIC, or Federal Deposit Insurance Corporation, was also created to protect consumer deposits and restore trust in the banking system. However, in the 1990s, financial institutions lobbied aggressively to overturn these restrictions, leading to the passage of the Gramm-Leach-Bliley Act of 1999. It's interesting that the Glass-Steagall Act and the Securities Act of 1933 were both passed back in the same year, right after the stock market crash. The difference was that the Securities Act of 1933, which established today's SEC, focused specifically on securities regulation, requiring companies issuing stocks and bonds to provide accurate financial disclosures to investors. This act was meant to prevent fraudulent activities in the securities market, while the Glass-Steagall Act was aimed at restructuring the banking sector to prevent conflicts of interest between investment and commercial banking. Both laws were responses to the speculative excesses led to the Great Depression in 1929, but they did address different areas of financial reform. So, who were Gramm, Leach, and Bliley, and what motivated them to undo a law that had been in place for over 66 years? Well, Phil Gramm, he was a Republican senator from Texas who was a major proponent of deregulation and free market policies. Jim Leach was a Republican congressman from Iowa who, despite supporting the bill, had concerns about the lack of consumer protections. And then finally, Thomas Bliley, a Republican congressman from Virginia, known for his support of business-friendly legislation and banking deregulation, together helped push and repeal Glass-Steagall, arguing that banks needed to diversify their services to remain competitive in a globalized financial market. The second law, which came around at the same time as the passage of the Gramm-Leach-Bliley Act, was called the Commodity Futures Modernization Act of 2000. And this law deregulated over-the-counter derivatives, including credit default swaps. Credit default swaps were essentially unregulated insurance contracts that allowed financial institutions to make enormous bets on risky mortgage-backed securities. The unchecked expansion of CDSs, helped fuel the housing bubble. So why was this particular law enacted? At that time in 2000, lawmakers and financial leaders believed that derivative markets were sophisticated enough to regulate themselves. The dot-com boom had led to an era of financial innovation, and there was bipartisan support for reducing oversight in favor to foster economic growth. Some policymakers also feared that excessive regulation could stifle American financial markets' competitiveness against their European counterparts. These policies encouraged financial institutions to take on risk that they may not have otherwise taken, leading to the proliferation of subprime mortgages, the bundling of non-performing assets, and the eventual implosion of the financial system in 2008. Banks and mortgage lenders aggressively issued subprime mortgages to borrowers with poor credit, knowing those bankers could offload the risk by selling these mortgages to Wall Street firms. And then these firms then bundled these subprime mortgages into mortgage-backed securities, also known as MBS. Not that MBS, this MBS, which was then sliced and diced into tranches as good, solid assets and sold to investors, including pension funds and foreign banks. The scale of the problem grew because many people were making a lot of money, such as rating agencies. They were incentivized by fees, assigning AAA ratings to these securities despite their high risk. As mortgage defaults surged, these securities lost value, triggering massive losses for institutions holding them. Meanwhile, financial executives enriched themselves through performance-based bonuses tied to short-term profits. Hedge funds profited by shorting the mortgage markets as documented in the 2015 film, The Big Short, and credit rating agencies collected fees while turning a blind eye to systematic risk. When homeowners defaulted en masse, banks that had over-leveraged themselves collapsed, culminating in the bankruptcy of Lehman Brothers and a $700 billion government buyout. As an aside, the book written by Michael Lewis titled The Big Short, Inside the Doomsday Machine describes these events very well. So, in the aftermath of the 2008 financial crisis, policymakers recognized the need for stronger consumer financial protections. This led to the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, which established the Consumer Financial Protection Bureau, or as we know today, CFPB. The CFPB was designed to oversee and enforce consumer protection laws in financial services, ensuring that banks, mortgage lenders, credit card companies, and payday lenders treated consumers fairly. Why was the CFPB created at all? I think what happened was in the 2008 financial crisis, it exposed the predatory lending practices, particularly in the mortgage industry, where subprime loans were offered to unqualified buyers. Many consumers were deceived by hidden fees and complex financial products, making it difficult to understand the true cost of the loans. The lack of government oversight allowed financial markets to manipulate markets, bundle risky loans, misled investors, all of which contributed to the economic collapse. One of the CFPB's important aspects was to create the Truth in Lending Act, which actually made it very clear for most borrowers to understand the APR, the amount borrowed, and the total amount of cost of the borrowing. During this time, the CFPB was given broad authority to monitor financial institutions, issue regulations, investigate complaints, and penalize bad actors in the financial sector. Over the years, the CFPB has cracked down on fraudulent activities, secured billions of dollars in consumer refunds, and implemented reforms to prevent abusive practices in lending and credit. There has been opposition to the CFPB, however. Despite its successes, the CFPB has faced significant opposition from these three areas. Number one is banks and financial institutions. They argue that the CFPB regulations impose costly compliance burdens and limit their ability to offer financial products. Secondly, Republican lawmakers who view the agency as an example of excessive government intervention in the free market. And then thirdly, corporate lobbying groups, which have spent millions in efforts to weaken or dismantle the Bureau. Since the inception of the CFPB, there have been efforts to curb the CFPB's power, especially under more deregulation-focused administrations. Key rollbacks have included reduction in enforcement actions, leading to fewer fines and penalties against financial institutions, scaling back protections on payday lending, which has left vulnerable consumers at the mercy of predatory lenders, delaying or repealing mortgage disclosure rules, making it harder for consumers to understand the true cost of home loans. And then the changes to leadership as each administration appoints directors with differing views on regulation, leading to inconsistent enforcement. These changes mirror the broader trend of financial deregulation, where short-term economic gains and industry lobbying efforts take precedence over long-term consumer protection. With the CFPB's power being diminished in recent days, there is concern that unchecked financial institutions may once again engage in risky practices, leading to another economic downturn. This time, it probably won't be subprime mortgages, but could be in the form of digital assets or the pooling of public money through sovereign wealth funds or through something else that might be on the horizon. So in conclusion, as we look ahead, we must ask ourselves, are we repeating the same mistakes? The weakening of the CFPB and financial oversight bears an unsettling resemblance to the policies that led to the 2008 financial crisis. If we don't take these changes seriously, we risk heading down the same path that resulted in millions of lost jobs, devastated retirement accounts, and economic collapse. While consumers and individuals must take greater responsibility in being vigilant about their financial decisions, this alone isn't enough. There must be a balance between personal financial literacy and sufficient government oversight to prevent bad actors from exploiting the general public. History has repeatedly shown that without adequate regulation, financial institutions often prioritize short-term profits over long-term stability, leading to disastrous consequences. Strong consumer protections and financial oversight ensure that markets function fairly, reducing the likelihood of another widespread economic crisis. Only through a combination of public awareness, responsible financial behavior, and robust regulatory frameworks can we build a more stable and resilient economy for future generations. If you enjoyed this episode, please like and subscribe. And until next time, stay transparent.